Good morning, everyone. Great to have you with us on a gorgeous, we all lose track of days at the moment. I think it's a Wednesday. It is definitely a Wednesday. But great to have you here. Thanks very much for your company. We will just, we'll wait a few moments for everyone to log on before we get things underway. So this is the second in the series that we had. I know a number of you will have been part of the first webinar, and we certainly look forward to doing what we can to help you out during, how do we describe the period we're going through at the moment? So many adjectives, but it certainly is, it's different, but we are getting there, and all going well. We will come out the other side. We will come out the other side. There is no doubt about it. So I can see logging on here that gee, they're very good. It was 10 o'clock start and nearly everyone is on. So that is absolutely fantastic. So we'll just give it a few more moments and we'll wait for the stragglers, and then we will hear from the experts. I'm the facilitator. I'm an expert in some things, but I'm certainly not an expert when it comes to financials and investing. So I can assure all of you that I find webinars and content and conversations like this absolutely invaluable, because I have so many questions as well. So I'm really looking forward to tapping into some very, very astute and intelligent minds here this morning. We will get things underway. My name's Brad McEwan. I'm your host / facilitator, and I also wear the hat as I'm a mental health advocate and a journalist as well, and a real focus of mine at the moment and during COVID has been making sure that people are okay. And what we all know is that when it comes to finances, that can be incredibly stressful, and that can lead to a whole lot of anxiety and a whole lot of worry. So part of today is answering all of your questions and giving you hope and just reminding you all that we will get through this. We certainly will. Now, a few things that you will need to know. We are recording the session. You can join in the discussion. All you have to do is jump on the chat function. Make sure there that you set the chat box to all panelists and attendees, and we will endeavour to get through as many questions as we can. As I mentioned, my name is Brad McEwan. This is the second in the Ask the Experts series. Today's title is, and you already know this, Beyond COVID, which is very optimistic and wonderful to hear, the economic impact and safeguarding your financial well-being. And we will be beyond COVID before too long. Why are we here? Because we know there's been so much chatter, so much commentary on the economy and what it means for Australia, what it means for us. So we've brought together a panel of experts to not only provide an outlook for the future, but explain what it means for us, for you. In particular, we're focusing on the questions: what does the future look like? How will the outlook impact me? And what can I do now? I think it's fair to say that we've all got a little bit of COVID fatigue at the moment, and I think that is natural. Somebody pointed out something the other day that really resonated with me. You know how we hear that saying that we're all in the same boat? And then other people say, well, we're not in the same boat. And somebody said, imagine this. Imagine we're in a boat in a storm. Imagine being on a yacht in a storm. I reckon that would be okay. Imagine being in a tinny in a storm. That would be tough. And the reality is, for a whole lot of different reasons, whether, you know, people are homeschooling, maybe they're living in a small environment, they've got other challenges as well. Maybe they're in that tinny, so it is harder for them. So I think a really important thing now is to acknowledge that, yeah, we're all in it together, but we're all got very different circumstances, and that is something that I know that I like to focus on. As I mentioned, I'm not the expert, but we do have our experts joining us today, and it is great to welcome, firstly, Beatrice Yeo, Economist, Vanguard Investment Strategy Group. Great to have you with us, Beatrice. Also joining us today, Mariana Subasic, advisor at Tribeca Financial. And as you may have worked out, that the final expert today is David Lofthouse, advisor also at Tribeca Financial. Great to have you all with us today. Beatrice, we're going to start with you. Some questions. First of all, we're 5 months into COVID in Australia. We constantly hear about the economic impact. It's very hard to avoid it, both here and overseas. Can you give us a summary of the current outlook for the future?
Yeah, sure. So, before we look ahead, I always think it's helpful to set the context for the current environment that we're in. And on that front, I think it's important for all of us to recognize that this current downturn that we're facing is one of the deepest recessions in history, both globally as well as here in Australia. In fact, in Australia, it's actually marking our first technical recession in close to 30 years. And that's a function of, experiencing both supply and demand shocks simultaneously, right? On the supply side, we have seen the extreme measures taken to lock down the economy and to contain the virus. That's definitely positive for public health. But, as we have seen from the data, it also comes with significant economic cost. And on the demand side, on the demand shock, we have also seen, income declines as people lose their jobs, as well as, consumer reticence, consumer fear, weighing on business and consumer spending significantly. And so that's why for 2020, in our base case scenario, we're expecting global growth to come in at around -3%, which is far worse than what we experienced back during the GFC of, only -1%. So pretty depressing news there. But, I'm sure many of you would have seen the headlines and read the news around these numbers. So, instead of dwelling on, these, gloomy statistics, what I would like to offer today is really some glimmers of hope that we see on the outlook. And on that front, while we say that this is one of the deepest global recessions on record, I would also stress that it's also, we're also expecting it to be one of the shortest recessions in history, especially, once the supply shocks fade as lockdown measures are eased. And, if we want to, look at some areas where we can see, some of these glimmers of hope, one place to look at would be the labor market. So, at this stage, we have seen that here in Australia, as well as, globally, most of the layoffs to date have been more temporary in nature, which means, that as social life gets back to normal and businesses resume operations, that there's hope that, the unemployment rate can come off much more quickly and help accelerate the economic recovery. Contrast that to, the last crisis back during the GFC, where unemployment rates also similarly surged to levels seen today. But the key difference at that time was that, at that time, around 80% of the layoffs and unemployment that we're seeing were actually structural or permanent in nature, which is a very different situation to what we're seeing today. So that's one positive side of things. And the other place that we could potentially look at would also be to focus on bankruptcy and default rates. And on that front, we have also seen on a year-to-date basis, both on the corporate as well as on the personal side, bankruptcies, the number of bankruptcies are still lower than the levels seen in 2019. Lower than the level seen during the GFC, and even lower than the level that should have been implied by the current rate of economic contraction in the economy as well as in the labor market. And I think both of these factors, both the labor market and default rates, I think the reason why we have seen limited scarring effects on the economy so far has really been thanks to the unprecedented and quick and decisive nature of policy, right? Whether it's on the monetary side or on the fiscal side. And so this gives us confidence that, the economy, while it might be the deepest recession on record, it should also be able to rebound pretty quickly in the form of growth rates. And this is what we've already seen in China in the second quarter, and it's also what we expect to see in the third quarter for Australia and most developed economies.
Beatrice, love your positivity. I mean, we all know we're in recession, but to hear you say that it should be a relatively short recession, we don't see that all the time. So I know that certainly instilled a lot of hope and positivity in all of us. So that is fabulous to hear you say that. Everything that you've touched on there, what does then that mean for the average Australian?
Sure. So, I would say I'm positive, but I'm not overly positive. Right? Because, what I just described there, it sounds very much like a V-shaped rebound of the economy, right? In the form of growth rates. But in fact, this V-shaped rebound only, in our view, reflects the first phase of the recovery process, really in the form of growth rates turning from negative to positive. But, we all know from simple math in our Math 101 classes, if we still remember back in the old days, that, if growth declines by 8% in one quarter, a rebound of 8% in the following quarter will simply not be enough to get us back to where we were in terms of the level of activity. So it's really in that sense that we say, it will both be a V-shaped rebound in terms of growth rates, but also a U-shaped normalization, really in terms of normalizing back to pre-pandemic levels. And the reason why this, second phase would take a much longer time is because of, what we call demand persistence drags. That is to say, even as lockdown measures are eased and supply shocks fade, I think many of us, both you and I, will voluntarily maintain social distancing measures as long as, a vaccine is not developed, as long as a vaccine is not found. Just think about it, right? Even as, governments reopen their borders and airlines are able to operate as per usual, I think it's another thing for us as people, and as consumers to say, I want to get on an airplane with 300 other people and breathe in the same air, right? It's a very different situation, whether you're able to and whether you're willing to. So it's really in that sense that we think that until an effective therapeutic treatment is being developed, that, the fear and uncertainty associated with COVID will continue to weigh on people's behaviors and prevent consumers from returning to their normal life, especially the social life. And that will have implications, on certain sectors of the economy, especially the service sector, that it's highly face-to-face intensive. So, that's more from a behavioral and societal impact. But I think from an investment perspective, one concern that I've also been hearing a lot from clients is the impact of low yields on their portfolios, right? Because as a result of the unprecedented policy support on the monetary side, we have seen yields fall to historical lows, both in Australia as well as globally. That is supportive for the economy and helps to, cushion some of the downside. But I think it also, raises a concern, especially among income-oriented investors, where, they're basically experiencing not enough income to actually, meet their daily spending needs. And so, I think many times a lot of investors will be like, hey, shall we try something new? Shall we search for yield? So we search for return, maybe let's overweight high yield debt, overweight, emerging market debt, or, concentrate within financials to, capture that higher dividend yield. All that's good. And our simulations actually do find that, doing all of those can actually give you a slightly higher expected return in the long term relative to a balanced portfolio. But you know what? It also comes with much higher volatility and much higher risk. As it really ignores the diversification benefits among the different asset classes, and could also, lead to an overtaking of risk exposures above and beyond what an investor actually wants to take on. So, instead of, focusing more on an income-oriented approach, what we often encourage investors to do is to adopt a total return approach where, it's really your goals and your risk tolerance informing the asset allocation, rather than your income yield target actually informing the allocation, which could lead to an overtaking of risk exposures.
So everything you've talked about there in regards to the outlook, Beatrice, how will that impacted or be impacted by perhaps what's happening in other states or potentially overseas?
Yeah, so I would say how fast or how quickly an economy recovers depends on a couple of factors, right? One is how effective the containment measures or containment strategies have been in that particular country or that particular state. So if we look at countries like China and New Zealand, they obviously have a much better control of the virus compared to, their peers in the UK or the US, where daily new cases do exceed the thousands. So that's definitely one factor. But the other factor that could also contribute to how quickly an economy rebounds is really around the economic structure of that state or that country. So, a country or a state that's more manufacturing or more industrial focused is likely to rebound much more quickly compared to a country or a state that's more service oriented with, a lot of focus on highly face-to-face intensive sectors. And so, to give you a real life example, we could look to, say, China versus the rest of the developed world. So China, as we know, was first in and first out of the epidemic. So, this partly explains why we are seeing it rebound much more quickly than the rest of the world. But the other part, that often gets missed is also really, going back to the economic structure of China, where around 50% of its output, we think, actually comes from industrials rather than services. Compare that to, say, Australia and the US, where only about 20 to 30% of our output comes from the industrial or the mining sector. And why that matters is because, we think that most industrials and manufacturing sectors, one, they have a lower initial supply shock, as they can largely operate under social distancing rules or have the ability to work remotely, as many of us are doing, like the financial service industry. And two, they also have a lower negative demand persistence shock, in the sense that, even after supply shocks are lifted, a lot of their product and service offer are not highly face-to-face intensive. And so they wouldn't have that negative persistence demand shock as we spoke about earlier. Contrast that to, say, somewhere like Australia and the US, where a lot of our output really depends on sectors like recreation, hospitality, entertainment, etc. And these sectors, one, they will have a larger supply shock, as many businesses we forced to shut down during lockdowns. And two, they'll also have a larger negative demand, a longer negative demand persistence shock, simply because of that fear factor, even after lockdowns are being eased. So, I think that that's the contrast that we're actually looking between countries. And even within Australia, I think it's also, quite evident when we look at states such as Victoria or, New South Wales versus somewhere like Western Australia, where Western Australia, obviously is more mining focused, more industrial focused. And so far, their containment of the virus has also been far more successful than somewhere like Victoria, where, our containment measures have, suffered some setbacks recently. And also, the fact that we're also more service intensive, that would also have implications to how different states actually play out in terms of the economic recovery.
Beatrice, thank you. Fabulous. Fabulous to get your insights there. And we will have some more questions for you a little bit later on. We'll move on to Mariana. Mariana, and I know I ask this question all the time, we hear about financial well-being. What is financial well-being and how do we achieve financial well-being?
Well, look, what we see with most of our clients that we sort of see day to day, what financial well-being is really is having a sense of security and a feeling of freedom. And what does that really look like for the individual household or for the individual person? It's looking at having a sense of security in the today, is knowing that you've got control of your day-to-day expenses. So, knowing, okay, the income that I've got coming in, this is what my expenses are, and I'm feeling in control and I'm feeling good about that. I'm not feeling at effect of this, right? So, you've got that sense of security. Having a sense of security for the future is really having that ability to absorb a shock. So, a lot of us have seen this shock, an unforeseen shock of what's happening at the moment in the world, but it's looking at if something was to happen, how would I deal with this? And what impact would this have on my family? Do I have this sense of security that I'll be able to get through this, not only financially, but also, from a health perspective and a mental well-being as well. So that's that sort of baseline of having that sense of security. And then I suppose if you look at the feeling of freedom, once you achieve that sense of security, then it's, well, what next? And having a feeling of freedom in the today is really knowing that you can make the choices and have the wants in life. So I know right now we all will agree on this, that we're probably quite limited to what choices we can have. But, as Beatrice mentioned, this is, a short-term thing. So what we've got to look at is, what is life going to look like beyond this? And what would my ability to have the wants and the choices in life really look like after that? And then the last one is having that feeling of freedom for the future, is really knowing, well, first of all, knowing what your goals are, more in the longer term space. Where do I want to be in 5 years' time? Where do I see myself in 10 years' time? And knowing that you're on track to achieving those goals. So knowing that you've got a plan in place to actually get you to there, and what does that look like? So trying not to have too much of a short-term focus, but also really looking ahead and looking, how can I get to where I want to get to in the next 5 to 10 years?
Mariana, for people in Melbourne at the moment, I mean, for all over the country, but in Melbourne, clearly there's a focus there. And I think I'm not the only one that looks on the daily COVID numbers every morning. And like a couple of days ago when we were 41, you sort of bounce up because it is so wonderful to see. And then days like today, you know, we're back in the 70s, but we know that there's going to be these fluctuations, but the curve generally is going down. So we're riding these peaks and troughs with our emotions every single day. And it can be really overwhelming for a lot of people. And I touched on earlier that financial stress is a significant trigger for a lot of people for poor mental health, because there's a lot going on and there's a lot of anxiety and there's a lot of worry associated with that. In regards to that financial well-being that you've touched on, is there a series of really simple things that people can take away today and go, right, concentrate on this and you're going to be a whole lot better off?
Yeah. So I think the key one, and I agree with you, Brad, and I think we all go through our own sort of roller coaster of COVID. You know, you've got days and weeks where you're doing really well, and then you've got days and weeks where you're not doing that well. And, you know, I think the first step is to just acknowledge where we're at and what's happening in the world. And it is okay. It is okay to be riding out the emotions. I think sometimes, you know, that sort of fear can overtake and make us feel more stressed and more anxious than if we just sort of focus on just being that it's okay. Trying not to have too much of a short-term sort of outlook. So, you know, you mentioned looking at the daily cases and working out, well, what does this mean for me? You know, what stress is this going to cause in my business or my family, or, you know, people that I can't see, and so on and so forth. Trying to have a bit of okay, well, once this all sort of comes back to normal, what's it going to look like, and what can I sort of do beyond that? So I think trying not to have a short-term focus is really, really important. Trying to bring yourself back to the long-term view, and then what does this mean for me long-term? I think one of the reasons that a lot of people do have stress and anxieties because they're playing a little bit of a head in the sand as well when it comes to their finances. And I think we see this, the more you put something off, the more stressful and anxious you can become about it. So I'd say the first step is to really sit down, whether it's, you know, you're by yourself or with a partner, and really work out where we're at in life. What does our financial situation look like? I think that's the first step, to really know, get a good understanding, get knowledge of where you're at right now in this moment in time. So what does that look like? You know, looking at what is your assets, you know, what's your home worth, what liabilities or debt do you have, and what's your sort of net position when you take that into account. Then looking at your income and expenses. Obviously, a lot of that, for a lot of us right now, the income may be reduced. But what you'll find is once you sort of sit down and put the numbers down as well, is you find that our expenses right now are really reduced as well. So we're not living the normal day-to-day life where we can go out and about and spend all this discretionary amount that we normally would have. So we're finding that people have more of the ability to save, even if their incomes have actually been reduced as well. So work out what's your income and what's your expenses. And that will give you a pretty good indication of, you know, do I have a surplus or am I in deficit? You know, am I in the minus, and what can I do about that? So once you've sort of got that understanding, is then looking at how can I build myself a bit of a cash flow buffer or a bit of an emergency fund buffer for that rainy day and, you know, that ability to absorb a shock, as I mentioned earlier. So if something was to happen that's unforeseen, how do I weather this and get through it without that sort of financial stress? And what can I do now to start building that up for myself and for the family? And I think the other one that's really important is reviewing your home loan. I think we mentioned this in the previous webinar when we had Jason on. It's a really, obviously in a time where interest rates are, you know, really low, why not make the best use of that? You know, why would you be paying banks higher interest than what you need to be? So the first step is really reviewing your home loans, making sure that you're on a comparative rate. And if not, then working out how do I either get in contact with my bank to reduce that, or see a mortgage broker to, you know, help review my home loan.
Okay, all fantastic advice. We've got a list of different things that we can do that can help, and absolutely invaluable. How then, what do you say to your clients then that are just struggling with everything that's going on, and they're saying, you know, all these things are valid, but I'm just not in that headspace to do all these different things. How do you change their mindset and push them towards a positive approach of saying, no, here's an opportunity here to make the most of a really difficult situation?
Yeah, I think the first and most important step is once again, depending on whether you're by yourself or you're partnered up, is to have that initial discussion, have the conversation that needs to be had. So whether it's yourself and your partner, really sit down and work out what is it that's actually stressing you out, because a lot of us will have different things that are stressing us. So maybe the lack of income, it could be the debt levels, it could be just the fact that we don't discuss finances, so we're on different pages when it comes to what our financial situation is. So I'd say the first step is to really sit down and come to terms and face what is it that's actually causing you stress. Once you know what that is, you can then actually do something about it. And I think the most important thing to look at is, Beatrice mentioned about the economy and what's happening out in the world. Those are the things that we can't actually control as individuals. We just have to, control the controllables, control the things that are happening in our lives that we actually have control over, as opposed to, waiting for this thing out there to sort of make that impact. So get an understanding of what's causing you stress, have that discussion with your partner or a friend or someone, a friend date or money date, if you want to sort of call it, and then work out what is it, what can I control, and how do I sort of reduce the stress for myself.
Okay, terrific. Mariana, thank you. David, when it comes to finances, and I could tell a little fib here and say, oh, all these other people say to me they don't know where to start, but you know what? Sometimes I don't know where to start. So what are some simple things that I can do straight away that are really going to help?
Yeah, great question, Brad. Look, a really, really good starting point for anyone, I find, is to spend a bit of time on a website called Money Smart. Now, Money Smart is a fantastic government-backed website put in place by ASIC, who are the regulator of the financial industry. So it doesn't try to sell you anything. It doesn't have any affiliations, but what it does provide is some fantastic foundation level information on superannuation, investments, insurances, budgeting, managing cash flow, loans. It's all there. It's all there, and it's nicely and easy to digest. Also, some really useful calculators on that website as well for things like mortgage repayments and budgets and that sort of thing. Another really, really good thing to do at the moment is, and Mariana touched on this before, is if you're finding that you're spending less, take advantage of this. Winston Churchill famously said, never let a good crisis go to waste. And we're finding a lot of families are spending less because of COVID. Really, really good opportunity to either build up your cash flow, your savings buffer, your rainy day fund, or make some extra repayments on the mortgage to make life a little bit easier further down the track. Another thing that's really good to do as a starting point, and often one that people will lean away from, is to understand your superannuation and how it's invested. Now, you don't need to know the exact ins and outs of every single exposure and every single investment that may sit underneath your large superannuation umbrella, but just at a high level to understand maybe what your allocation is to defensive type assets like cash and fixed interest investments versus growth type assets like international shares, Australian shares and property. And if it's not too clear or not immediately obvious when you're looking through the information that you have on your super fund, pick up the phone, give them a call, ask them to explain it. I'm sure they'll be more than happy to explain what it is that they do for you. I think the last one that's really important to pick up as a starting point, and Mariana again touched on this slightly, is take a few minutes just to review what your plan B arrangements are, what your contingency arrangements are, your estate plan and your insurances, your safety net. Start by asking yourself, what outcome would you want for your family if something were to happen to you? Would you want them to be worse off? Would you want them to be better off? Or you want them to continue their current lifestyle? That's a really good starting point there. To put into context why this is so important, we actually recently worked with a young family where the husband unfortunately passed away following a hang gliding accident. Now, he passed away without a will, and the couple had assets that were predominantly in his sole name. So the partner now is in a position where she's actually unable to access readily the funds that she needs to cover the family's ongoing costs of living. And actually, further to make things a step worse for them, she's actually now technically taking her young children through legal proceedings so that she can retain ownership of the home that they will live in. That could have easily been avoided if they had even basic estate planning arrangements in place. So a really important one.
Absolutely. And touching on that, David, it's so important now that we're looking at finances and how we can do things better and smarter with couples working together. as a team, isn't it? That is so important. And you touched on that in that story. Needs to be communicating. You need to be working together on this stuff.
Oh, that's absolutely right. That's absolutely right. And look, there's an unfortunate statistic there that 50% of divorces stem from financial issues, from financial frictions. Yeah, that previous estate planning example really highlights the importance of both members of your unit at least being across what your current position is. We tend to find that there's one sort of finance expert in the house. It doesn't necessarily have to be that you're both 100% across all the ins and outs of everything, but ideally you want both people to at least have an understanding of what your situation is. We insist, for example, for our initial discovery appointments that we have both members of a couple attend that appointment, because a lot of what we go through there is understanding what your current situation looks like, but also exploring what your short-term and your long-term goals look like. You're in it together. Your goals need to be aligned, or you need to have an understanding of what each other's goals look like for you to understand where it is that you're getting to. It's really important that for your success, that you understand your situation, that you both have input into your plan, and that you're both taking accountability for achieving those goals. Then it means that you can celebrate together as well when you do achieve.
And while this is happening, sorry, Mariana, you had something to add there?
Yeah. I was just going to add on, on David's point further is, I guess, a little bit more insight into why we all have different relationships with money. So, there's a lot of research out there to suggest that our relationship or our attitude towards money actually gets formed by the time we turn about 9 years old. So if you think about that, that's quite a young age. And if you think about the influences that you have around you, it's generally going to be your family and friends and people at school that will influence how you form a relationship with money. And then if you think about that over your period, and then when you meet someone, if you've got two different people with two completely different relationships with money, one may be, I have to save everything, I have to build for tomorrow, and that's really important to me. The other one will be living for today and spending everything. And if you've got those two people in a couple trying to work together towards a goal, it can become quite difficult because you've got two people pulling in different directions. So it's really important to have that conversation, to get things out and open, to start talking about understanding each other's point of view, so that you can then move forward together.
Absolutely. And David, as Mariana touched on there, these conversations, they're happening at home at the moment, and everyone's privy to them because the kids are there and there's nowhere really to hide. So for those that are watching here that have children, bring them into the conversations where you can. I'm sure they don't want to know everything because, they might find it a little bit not their sort of cup of tea, but bring them in, and here's a great opportunity to be educating children about the importance of having that financial understanding about how life works.
Yeah, that's absolutely right. And, the important thing to bear in mind is that your children learn their money habits from you, the same way that you learn your money habits from your parents. And Mariana mentioned that research before, that your foundations of your relationship with money are formed by the age of 9. So it really highlights the importance there that if you do have children, to start having conversations with them about money from a young age. I mean, especially in the current environment, they're learning about recession and economy and these sorts of terms that they might not necessarily understand, and they don't necessarily have the same capacity as adults to differentiate between what's an opinion and what's a fact. And there are an awful lot of headlines and articles being bombarded at us all day, every day, and children soak all of this information up. So it's a really good opportunity, I guess, firstly for yourselves as parents, is a good test for your own understanding, that if you can explain these things in nice, simple terms, well, then that clarifies your own understanding as well. But then a fantastic opportunity to also check in with your children as to how their understanding is developing with these things. Ask them to explain it to you.
We've had a lot of questions come in while we've been having the chat, and we've also had questions come in prior to today. Here's one that's come in this morning from Brad Fox. Thank you, Brad. And I'll send this your way, Beatrice. We're talking about children. The kids are probably saying right now, righto, when all this settles down, where are we going on holidays? So if Australians were spending around $64 billion on overseas travel, and our revenue from inbound travel was around 32 billion, so half, is this not an opportunity for all of those people that would go overseas to stay within Australia and we can really focus on that. And surely there are enormous opportunities for tourism within this country going forward.
Yeah, sure. So, it's definitely true that here in Australia, we're a net importer of tourism, right? In the sense that, more Australians go abroad than, overseas visitors come to Australia. But, I would say as a whole, if we look at the tourism industry in Australia, it's around 3% of GDP. But at the same time, you recognize that around 70 to 80% of that is already concentrated within domestic travel, and only about 20 to 30% comes from, overseas travelers spending within Australia. So to that extent, I think, the upside, potentially they could spend more, right? Once you bring your kids after this lockdown fatigue to, say, the Gold Coast, that could definitely help boost up the share of domestic travel as a proportion of the total tourism industry. But I would say the upside isn't that significant, right? Given that tourism is already accounting for the large majority of tourism revenue here in Australia. So I would say, rather than focusing on tourism a lot, I would say the Australian government has done a pretty good job as well in terms of diversifying our economy, right? If we just think back, back to 2014 and back, to the last decade or so, where we were so heavily dependent and so reliant on one sector, which is the mining sector, that, at its peak accounted for about 10 to 12% of GDP. But, as we have seen today, fast forward about 10 years to 2020, which time flies really fast. We see that the mining industry has, by itself only accounts for about 5%, 5 to 7% of our GDP, while our domestic service industry is definitely growing, not just in the tourism sector, but we also see things in, the recreational space, the hospitality space, as well as financial services here. So I think it's definitely, we're definitely headed into the right direction. And I would also add the other thing that, Australian governments are also, I would say having top of mind at this point in time would also be diversifying their export base. Because at this time, within that 20% bucket of tourism revenue that comes from overseas travelers, a good proportion, around 30 to 40% of that actually comes from Chinese tourism. And we know, that with the recent tensions between Australia and China, there has been some, threats thrown out there that, Chinese students and Chinese travelers might not actually visit Australia anymore. So from that angle, I think it's also important, not just from the commodity export space to diversify our export base, not just to focus on China with our iron ore exports, but also within the service sector, to also make sure that we're not overly vulnerable to one particular country.
We touched on earlier about children. A little shout out here. Wendy Cole, I'm impressed. Wendy Cole has sent through a message. She's telling us that her two daughters, aged 8 and 10, are all watching this right now. So to Wendy and your girls, I know that you're getting so much out of it, and that is very impressive. And that's what we've been talking about, as David touched on there before. David, what would be the best advice you think that your clients could have taken on last year to prepare them for everything that's going on this year?
Really, it's all of the above, to be honest. It's taking that step to understand what your current position or what your position back then would have been back then. Sit down and explore as a household what your goals are, what your long-term plans are, and really embed this idea of resilience and sticking to the plan, that if the economy or if the environment changes, keep your eyes on the prize and keep your eyes on what your priorities are.
Okay. Mariana, for a lot of people, a priority is bricks and mortar. What do you think the repercussions will be for the property market? And if we're sitting back there and we're in a position where we'd like to buy a property, when do we do that?
If I had a crystal ball, I'd be able to give you that answer. Look, property market, as we've all seen, has obviously taken a bit of a dip, like everything else has recently, especially this year. In Melbourne, it's really difficult, especially at this time, given that there's no inspections and there's really not much activity happening, especially on the sort of residential front. So really difficult to work out what is it all going to look like. Based on some of the conversations that I've had with people in the industry, what they're sort of thinking is towards the end of the year, generally how property real estate sort of shuts down around that sort of December period, and then there's that kind of month of no activity. what they're thinking is that given that we've had so long off now, that there's probably going to be a lot of people selling and buying around that time. So Christmas, they think that the people just sort of go through. So really difficult to tell. I would say that there'll probably still be a little bit of a further dip in the property market. But I think for people, it's what David mentioned earlier about, you know, work out what your plan is, and does buying an investment property, you know, does that form part of your plan? Or is that just something shining silver that's just happening right now that's taking your attention away from what's actually really important to you and your family? I think we as Australians love property, and you know, we have this relationship with it, but I think a lot of people don't realise the risks that are involved in purchasing property. So what you also have to work out is, you know, what is your ability to borrow, and you know, what impact is this going to have on your cash flow? I think a lot of people, once again, they get excited about negative gearing and tax brackets and all that, but they don't realise that they do actually have a cash flow impact throughout the year having properties that are negatively geared, because they do cost you. So, you know, would you be able to afford that? What does that look like? Is that actually going to cause more stress on the family, or is that you know, going to give you more of that sort of security and freedom back? So really working out why you want to buy an investment property. What's the purpose of it? Is it in line with your goals and what you're working towards? Or then exploring, is there other options where potentially maybe you don't have to borrow, that you can invest for the longer term? So really sitting down and working out what are you working towards, and what sort of investment will get you towards that is probably the most important thing, I would say.
Okay, and over the top of all that, we have the word that we touched on earlier with Beatrice, is recession, which brings about a lot of uncertainty and anxiety. Given that we were in a relatively strong position before COVID, Beatrice, in regards to the recessions that maybe Australia had to have, to quote Paul Keating, where does this stack up, do you think? If you could look into your crystal ball that Mariana didn't have, but maybe you have, how do you think this is going to unfold? Not a hard question.
Yeah, I mean, I think before we go into a debate on whether we started off in a better position this time around compared to the 1990s recession, you know, I think it's important to first, again, go back to the nature of this shock, which is very different. And, you know, it's very unique in the sense that it's both a supply and demand shock. If we look back, you know, whether it's the GFC or the 1990 recession, you know, that was really driven by a demand shock, really caused by, you know, the asset price bubble bursting, you know, as a result of excessive leverage and excessive imbalance in the financial system. But, you know, the very fact that this time around we have both a demand and a supply shocks happening at the same time, you know, I think the very fact that we have two instead of one, you know, explains why we're expecting this downturn to be much more severe. And I think we have already seen that in the data, right? The GDP results for Australia for Q2 came out last week. And, you know, we saw that for Q2, that -7% Q-on-Q drop was actually the deepest quarterly contraction on record in Australia's history. You know, even during the 1990s, where we had an official technical recession, the GDP only decreased by about -1% versus the -7% that we saw in Q2. So I think from the angle, I think we all are on the same page that this shock is definitely one of the worst shock, if not the worst, in Australia's history. Now, I think the question comes to whether we're in a better position for the recovery. And I think, you know, in general, yes, you know, whether we look at the more temporary nature of layoffs, or, you know, the level of bankruptcies do lower than what we would expect in prior downturns. But I think one key unique factor differentiating Australia from, you know, the rest of the developed world, whether it's the US or Europe, is that unlike the US, you know, which has largely completed its, you know, prolonged deleveraging process post the GFC, you know, here in Australia, we haven't even started that deleveraging process at all, right? With household debt to GDP ratio, you know, continuing to climb to historical highs. It now stands at around 125% of GDP, which is, you know, one of the highest in the world. So there's definitely a risk there that, you know, if we see a large collapse in asset prices, like house prices, for instance, that, you know, that could trigger a period of financial stress in the system. You know, so that's definitely a tail risk, but I would say it's not our baseline scenario at this point in time, because, you know, of the very accommodative monetary environment that we're in, that, you know, while monetary policy doesn't help provide a lot of upside, you know, it actually helps to cushion some of the downside, as it means that the highly leveraged households and corporates can continue to survive and roll over their debt rather than engage in bankruptcy or defaults in the near term.
So David, I come to you tomorrow and I say, look, I've got a little bit of money to invest now because I'm inside every night and I'm not, apart from a few groceries, I'm not spending on really anything at the moment. What would your advice be? Where do I spend that? Do I put more money into super? Do I jump into stocks? What would you suggest?
Yeah, look, good question, Brad. The key thing again, and I'm sounding like a broken record, is to stick to your plan and to try and tune out of a lot of the noise that's happening around us at the moment. The Financial Services Regulator actually recently provided some research showing that since COVID started in Australia, retail investors have lost $76 million in day trading activities. So that's someone buying a stock and selling it on the same day and trying to make some money from it. Now we're finding a lot of people, because they're stuck home or because they've got on their hand, they're spending a bit more time in that sort of space. The headline to take from that is that overall, people looking for quick wins are not winning. The most important thing to overlay your investment decisions is when you're going to need the money. And if it's within the coming months or coming years, Beatrice mentioned, we're still likely to experience volatility going forward as we're still very much not out of the woods with this COVID situation yet. Superannuation question's great because it's really important to remember that super is locked away until we retire. So if you're in a position you find yourself in that a lot of households are at the moment where you've got some cash savings but maybe not quite enough, diverting money towards super isn't going to help you build up that cash savings buffer. The best option that we're finding for a lot of people is to really focus on building that, or focus on making overpayments on your mortgage or on other debts to build yourself a bit more wiggle room there. The idea is that savings is not to be spent necessarily all on travel when we can go overseas or in the state again, but to really park it to one side as your rainy day funds that covers you for, say, 3 months or 6 months worth of your home expenses in the event that your household does suffer a financial shock.
Okay. A question from Nicholas. Good question, Nicholas, because I have wondered this as well, and I'll put this to anyone that wants to answer it. Back to our crystal ball. What is going to happen with the commercial property market? Because, with everyone working from home and we're seeing a shift where going forward, that might be the norm for a lot of organisations, the demand for commercial office space will not be there. So what's going to happen in the commercial property market? Does anyone have an inkling?
I can put out some comments and the rest can follow through. I think one of the impacts of COVID, the title of this panel, beyond COVID, right, is that, I think people are starting to focus more on the long-term consequences of this kind of change in environment that we're in. And, I think COVID has really accelerated some of the longer-term trends that were already in place before COVID, but it just, further served to accelerate some of these trends, whether it's US-China tensions, or even, the move towards a more digital economy or more virtual economy, right, in terms of the likes of, Amazon, or those who have the infrastructure for digital networks, those really gaining an upper hand this time around, as we've seen, with the equity market performance. But, also on the commercial side, I think there have also been, some, concerns that as more and more, offices, especially financial services, start to work remotely, will that really indicate a permanent shift towards remote working and, kind of reduce the importance of physical working spaces? I would say at this point, our view is that, it's probably going to be a more gradual and long-term transition to that, steady state. Rather than actually, being a near-term concern at the moment. And if you look at surveys taken by multinationals, I read a survey the other day by Gartner, and they basically suggested that most multinational companies at this stage, they still have plans to retain their physical working spaces. Only about 20% of those multinational companies said that they were planning to move around 10% of their workers to work permanently from home. So I would say still the minority at this stage. And if you think about, office leases, those are usually, multi-year leases. It's not something that, can be easily, cut off just because of this environment. So I would say, in the near term, it's probably not such a big concern, but yet, over time, I would think that, there will be a gradual transition as more and more people, start to work from home. But, I would say it's probably not going to be a massive transition, even in the long term, because if you think about it, I think all of us here as office workers, we still enjoy, the company of our colleagues. And, there's also, from an economic perspective, there's also value in being together in, one working space, what we call the idea multiplier, where, it's easier to share ideas and bounce off ideas of your colleagues. And so it's really the sharing of ideas that we think, will be the next driver of productivity growth. And we think, that physical working space will definitely be important in contributing to that.
Okay, fabulous insight. And yeah, I think we all agree there, just catching up and having heading out for a coffee or something is something that we've certainly all missed, or most of us as well. Okay, it's nearly time to wrap up. So what I will ask from our panelists is one key takeaway that our audience can take with them. We'll start with Mariana. What do you think? What's the one key thing you would say to everyone? Focus on this.
I think what I would say, and I've been harping on about this, is get an understanding of your financial situation. Really sit down, whether it's setting up a date with a friend or whatever that is, or your partner, but really sit down and have that conversation. Bite the bullet, have the conversation that needs to be had, and then you can sort of deal with what you need to deal with after that.
Okay, David, what about you?
Yeah, the big one for me, I'll come back again to that building up your rainy day savings buffer as being the number one action item for everyone, really. Understand what your expenses look like, understand how much you need to cover 3 months of that, and then take that as a starting point.
Okay, and before we get to Beatrice, before we go, if you do have a final question, it's not too late. Just jump into the chat function and right away, and we will get to that question. But Beatrice, for you, what's the key takeaway you think people can focus on?
Yeah, so if I were to summarize the economic outlook, it would be to say that we're expecting a deep contraction, a quick rebound, but a slow normalization process where, demand and supply dynamics would suggest that we get a V-shaped rebound in terms of growth rates, but, more prolonged U-shaped normalization in terms of returning back to pre-pandemic levels. And that probably means that, yes, the recovery will continue, but it will probably be also very fragile and uneven. And coupled with the fact that, we have multiple geopolitical tensions also coming back to the forefront, like U.S. elections, U.S.-China tensions, et cetera, I think we should expect to see more volatility down the road. But, I would say my advice to investors would be, rather than trying to time, when these volatilities period occurs, it's better to focus on what you can control, as, both Mariana and David has mentioned.
Okay. And Mariana, are you finding with your clients generally that, while there's a lot going on, but there is a degree of optimism after you meet with them and talk with them, and they have a better understanding of how things will play out?
Yeah, most definitely. I think a lot of people, no one is immune to what's happening out in the world. So we all get impacted by the news sharing and, hearing the stories and everything else that's happened. It's completely normal. But sometimes we forget how lucky we really are. And I think having that conversation, having that nice reminder of, you still have some level of security and freedom. And even though this is just short and temporary, we will get back to some sort of a normality down the road, whatever that looks like. Another thing that I would, challenge people to think about is, once we can travel and do all those sort of things, why don't you start sort of planning and putting some money away towards that goal? Start looking towards what's the next thing when I can travel, when I can get out and see family. Why not start putting things in place to get you to achieve that goal? Because that will make this whole, ride through it a lot easier for all of us.
Okay. And David, the reality is, because we have been inside and we have been in a curfew here in Melbourne, and for those that are still working, they might be in a position. I mean, there are always positives, and mindset's so important right now, isn't it? I remember early days with COVID and everyone was saying we're stuck at home. And then I read the simplest quote on social media. It said, "We're not stuck at home, we're safe at home." And in an instant I thought, yeah, that's 100% right. for people that and that are in a position where, you know, they can make the most of what's going on at the moment. There are opportunities. There always are opportunities, aren't there?
Oh, that's absolutely right. And I think a really important thing to bear in mind is throughout all of this, we've all got a lot more time on our hands, or a lot of us have got a lot more time on our hands at home. So whether it's spending time with the family, spending time with the pets, exercising, learning languages, all of those sorts of things, there's more time in the day to allow that for now. So I think finding a hobby or finding something to focus on outside of the daily number of deaths and cases that we keep getting updated on, find something positive to focus on rather than just tracking that number. And Mariana's done a really great job of summarizing that sort of stuff as well.
Okay, one final question. Gee, I could get into trouble here. Stevie Jade has asked, what about at home, and perhaps one of you is being very frugal or watching the savings, and maybe someone else is sort of online and buying everything they possibly can. How do we go about sort of meeting in the middle and going, well, hang on, there's no point not spending here and we're spending it all here. What does that conversation look like? Anyone?
I'll take this one. Yes, very interesting. It can really go either way. So as I mentioned, you know, having that, set up a time to actually have the conversation where you both know what you're about to speak about. And as opposed to starting with, you know, the differences of things you disagree on, why not start the conversation with what are the things that we both agree on? What are our common goals and common objectives and the things that we're on the same page about? Because I think that allows for a safer space to have the more difficult conversations. So once you've got that base laid out, then it's okay, well, what are the things we disagree on and how do we work through that? And understand that from both parties, there's going to have to be some level of compromise.
Communicate. Communicate. Absolutely. That is the key, isn't it?
Yeah.
Look, to all of you, to Mariana, to Beatrice and David, thank you very much. It's been just fabulous to get your insights and tap into your knowledge for those of us that aren't experts in this area, and you are the experts. So we really appreciate that you've given up your time this morning. So thank you very much.